But the U.S. economy is composed of people like me and my friends Scott and Greg here, and you who are watching this, going to work, going to school, buying stuff at Costco, going to the gas station. That's what matters, not who sits in the White House. If you knew exactly what was going to happen, you would need zero financial planning, because you'd be like, oh, I know what's going to happen. We plan because the world's uncertain. We plan to take into account what might happen with the tax code, what might happen in the world. That's why we plan. For some reason, people hate simple answers. Humans like to reject the notion that something can be so simple. Where's the pill? Where's the complex thing? Where's the 6 or 7 step thing I need to do? You'd feel like you got ripped off. Investing is pretty simple, which is, invest more than it's invest more than you spend, and put it in the market and wait. That's really it. But nobody wants to hear it.
Welcome back to the Personal Finance Project. Today, Scott and I are joined by Michael Antonelli. He's a managing director and market strategist here at Baird, and the voice behind the popular Bull and Baird blog. He's also a co-author of All That Matters, Baird's weekly market note that distills headlines into what investors actually need to know. With a background in history and an MBA from the University of Chicago, Michael has a gift for making markets make sense, whether he's breaking down volatility or calling out financial nonsense with humor and clarity. He helps investors see the bigger picture. Mike, welcome to the show.
Thank you so much.
Mike, you're clearly overqualified to be on this podcast, so we appreciate you for joining us.
Yeah, listen, I have a lot of hot takes, a lot of them around the markets and behavioral investing. So I'm glad to be here, and let's bring some education to your listeners.
All right, I was looking for lukewarm takes for the most part, but we'll see how that goes. But Michael, to start out with, one of the things that we wanted to talk about was that it seems lately that whoever is in the White House tends to lead people to view their investments and how the market is going to perform very differently. And so I guess I want to just see what you thought about that phenomenon, how it's progressed over the last 8, 10, 12 years, and where do you think we go from here?
Yeah, so there's something as a market strategist that I have finally landed on, and that is the fact that I will spend the rest of my career talking about politics. I didn't think I would. I never expected markets and politics to have such an intersection, but it's all I get questions about. And I go all around the country. Baird has, about 160 different branches. We have 250,000 clients, 1,400 advisors. Here's what I have experienced over the past, let's call it 4 years, okay? During the previous administration, every single event I went to, I had to answer questions about us turning into a socialist nation. And then when the election happened, I now go to events and people are asking me if we're turning into a dictatorship. So these are just two sides of the same coin. These are people who have conflated politics with the markets and investing and said to themselves, this must matter because I hear about it all the time and it's the only thing that comes on my news channel. What I like to remind people is this, is that the United States economy isn't a function of who sits in the White House or the party, okay? And I know they have policies. There's been lots of policies throughout the 200 plus years we've been around. What's important for you to remember is that, yes, there's a lot of noise generated out of DC, but the U.S. economy is composed of people like me and my friends Scott and Greg here, and you who are watching this, going to work, going to school, buying stuff at Costco, going to the gas station. That's what matters, not who sits in the White House, even though it tends to gain all the noise. So just know that whatever your views are, and I'm not here to weigh on them, somebody has the opposite views, and they're asking me questions just like you do. So just remember that.
Well, yeah, and it seems like we're as close to 50-50 as we've ever been, regardless who wins. So you're right. For every person who's certain that the economy is going to the moon now, there's somebody else that thinks that we're going straight to the gutter.
Yep. And by the way, any sentiment survey you see about the markets, and there's lots of consumer sentiment surveys, like all these different, University of Michigan, whatever they are, they're all just political surveys. That's all they are. Yeah. If you were to look at them separated by Democrat and Republican, Democrats now think the economy stinks, Republicans think it's good, but it was the opposite literally 6 months ago. So these are just political surveys. That's all they are.
Yeah, and I think a lot of people allow who occupies the White House to color their expectations of what the future is going to bring in terms of returns or how equities are going to perform. And you sent us an interesting little clip from obviously a piece of data that you had, which showed if you just invested with the Republicans, if you just invested with Democrats, or if you just invested. And it's not even close. And I think The other chart that we had demonstrated it really didn't matter who occupied the White House. Most of the time, you did fine.
Not only do you do fine, like so I did a bunch of election events, my friends, last year, like for Baird clients, and I said this. I said, you know what, in 1970, I think it was 1976, a man named Howard Schultz founded a coffee company in Seattle, okay? His idea was to sell the world's most bitter coffee, okay? That was his whole idea. And he founds this company named Starbucks, okay? They found this company, and Starbucks is now everywhere, okay? Everywhere. Do you think that Howard Schultz, when he founded that company, thought to himself, I'm not doing this if a Republican's president, or I'm not doing this if a Democrat's president. I'm not selling like $18 lattes filled with 100 grams of sugar based on who's in the White House. No, they don't. They just go to work and solve problems. And just one more point to hammer that home. No matter who won the election, okay, whether it was President Biden or now President Trump, all of us were going to work the next day. All of us. We were all going to work no matter what happened. And that's what matters. You don't want to invest based on who the president is. You want to invest based on entrepreneurs and companies solving problems. And that's what we do here. That's so great.
Yeah, and Mike, one of the things that I told people right after the election was, if we wanted to like break this down to something that actually might matter, it's like, okay, one party is saying they might let go of a whole lot of government employees. That would mean they don't show up to work tomorrow. That's the only thing that very first day seemed like it might be a big difference to me, as opposed to the economic direction.
And by the way, I mean, Elon Musk and the whole Doge thing, it happened. The stock market's close to an all-time high. Like
yeah.
We're less than 1% away. It has little to no impact.
Yeah, so I think what that just kind of tells us is, we were joking around the other day that in the markets nothing ever happens, and that's I think a good transition to the next point we were going to talk about, which was the power of doing nothing. And do you want to kind of give us a little bit of your thoughts on that?
Let me equate this to a storm, okay? Because you guys have storms in Texas, right? I assume you guys get those really bad storms that come through. We get them here. I live in Wisconsin. We get them too. In April of this year, when the market was really having a tough time, I wrote a blog. I hope everybody read it, called "Riding Out a Storm," essentially. And I said, look, there was a moment I was driving in my car with my family, and a storm was so bad I had to pull over. Okay, I had to pull over. There's nothing I can do about it. I can't stop the storm. All I can do is just plan for what's going to happen and then do nothing. I pulled over. I waited for it to pass. And that analogy in April, my friends, ended up being dead right, because it's now June and the stock market's close to an all-time high. The power of doing nothing is you just saying, gosh, there's stuff out of my control. I can't control tariffs or Iran, or I can't control like the government spending. But what I can control is my reaction to it. And that's why advisors are so powerful, so powerful, because they help you understand that sometimes doing nothing is the correct choice.
Yeah, and something Scott and I were talking about with regards to investing is most people their whole lives have been told that their success will scale in proportion to their efforts. You get up early, you try hard, you come in, you stay late, and you'll see yourself kind of rise through the ranks. And I think that human beings are born with this mild but persistent itch to strive. And that's why we're constantly counseled on hard work and effort. But yet investing, I think a lot of people have a difficulty not wanting to reach in their portfolio and make some changes when you have tariffs, when you have a war, and all these other things that happen, because we've been so trained to think this way. So how do you get people, or how do you counsel people to go against their intuitions, which is telling them you got to work really hard, you got to be doing something proactive in order to preserve your portfolio, or in order to earn more, what have you?
Not only control, but like intelligence. I think there are people that think, hey, I'm a rocket scientist, I'm a doctor, I'm like a high-powered attorney. That level of intelligence must mean that I'm a really good investor. And that's not necessarily the case, because good investing is not about raw intelligence. If it was, just PhDs would just be the richest people in the world. PhDs would just solve every investing problem. But I know janitors that are millionaires, janitors, because they can control what matters, and that's your behavior. The human's ability to survive relies on this kind of thing we have in our brain that makes us risk averse. Okay, we hate fear. Human beings have survived this long because of risk averse. So when we lose control, that kicks in, and you say, I must do something. The best way to do that, my friends, and I think I'm not meaning this to be like a selling point completely, but most people just want to talk to somebody when they feel a loss of control. So if you feel that loss of control, the best thing you do is pick up the phone to an advisor or your teammate or a friend and say, hey, I'm feeling just a little lost right now. Can you just talk to me for a little bit? And I'm convinced that would solve 90% of problems. But just remember that what you're going through when you feel that loss of control, everybody else is too. Everybody else. We're all in the same boat. I hate it too. We all hate it. It's just a matter of how you react, and that's why we're here, to help you react correctly.
Yeah, and I think you might be able to blame us in some way for perpetuating this situation, because I think a lot of advisors justify their fee by saying, well, we always need to be tinkering and trying to outperform the market in some way. When you're right, if we just have a conversation to get through that time of stress, that's so much better result than changing something within the portfolio.
I kind of say when clients call advisors, they're looking for one of three things, and I just say the three H's. They're looking to be heard, helped, or hugged. Now, hugged is comforted, right? But you know what I mean. Heard, helped, or hugged. I think very, very often people think they want help when really they just want to be heard. Hey, this is happening in the world. I'm scared. Should we do something? Should we not? They just want to talk through it. And I think the best advisors, the ones we have here at Baird and this team specifically, know which of those H's that are really important in that moment. And I'm a big fan of advisors just listening, because I think empathy is a huge part of this job.
Totally agree with you.
Absolutely. And I feel like when you are a human being highly adapted for the savannah, where long-term thinking was tomorrow and compounding didn't exist, it's really difficult to see through or see past something like us entering a conflict with Iran or tariffs or Donald Trump ascending to the White House again. So I think that having the ear for a person and just listening to their concerns, and then again drawing them back to the history of the markets and how well things have done and how these external situations have not materially changed the needs that they have from their portfolio, I think that's extremely valuable.
You know, I just throw this hot take. This is my first hot take for the group. All right, maybe this is not. Maybe this is lukewarm. I think that the success of an investor is inversely correlated to the amount of news they consume. So let me say that another way. The more news you consume, the worse of an investor you will be. That probably isn't a hot take. That might be a lukewarm take. But I'm telling you, if you watch 6 hours, I've never met a single solitary incredibly successful investor that watched 6 hours of news a day. It just never happens, because you just make yourself afraid. It just happens.
Yeah,
Totally agree. I think it also. Go ahead.
I was just going to say, I think Richard Thaler, one of the fathers of behavioral finance, I suppose, he, I think, did a study where they gave investors access to basically their portfolio performance on various intervals, and the higher frequency led to worse results. And the people who did the best were basically those who got their statements once a year, because they never really had to live through a difficult period if you were only looking at your investments once a year.
I mean, imagine you were on vacation in April.
Oh, I know. Scott and I were just talking about that. Yeah.
You never would have known.
If you were asleep for the first 2 weeks of April, you did fine. You did great.
And I was talking to a buddy. I was in California this weekend, and he works for a private equity firm. And we were talking about why people are so attracted to that asset class. And we both agreed that not being marked to the market is one of the biggest reasons why people like it. Because, you know, their long-term returns not necessarily better if we look at fund of funds, but not seeing it go down by 20% in the first couple of weeks of April, that's a huge difference.
Yeah.
You want to know what most people's best performing investment is? And maybe not wealth management clients, maybe just the average person. It's their home. Why? Because they buy it, they live in it, it's never marked to market, it goes slowly over time, and 30 years later, a baby boomer's selling a $50,000 home for $900,000.
Yeah.
It's just, it's the same principle. And I think I want everybody listening and watching this to remember that the more you tinker, the bigger the chance of a mistake.
Yeah, and you're right. You can't really tinker on your own house. I guess you can with construction, but not with selling it.
Yeah, but if somebody showed up at your house every day offering to buy it, you would get annoyed with them and tell them to stop right away. And yet we allow ourselves to essentially get these solicitations from the market on our portfolios, not just every day, but minute by minute. I mean, we allow ourselves to be essentially we allow our emotions to be controlled by how the market feels about our portfolio every single second of the day because we have access to this stuff on a minute-by-minute basis.
Yeah, it's tough. I want everybody to know that the more you look at your account, the more chances you have of saying, oh gosh, I'm down X. And I think the number one thing I hear from clients when I go out on the road and say the market's close to an all-time high, they say, well, my account isn't. I know the market is, my account isn't. And I'm like, hey, look, I know you're in more than just the S&P 500. You're in a whole bunch of other things. Let me just tell you that, you're just looking at a snapshot in time. Most of the time you will be below your all-time high, but every now and then you're going to be back there.
So kind of diving into the behavioral finance side a little bit more, what do you think it is about human nature or just people in general where we desire so much to predict the future?
At least with
we
the
do.
markets.
We do. Human beings, they cannot accept the fact that there is uncertainty about the future. Human beings want control over everything, and that includes their financial lives and their health and all these things. And while that is a very noble trait of humans to want to control things, you have to at one point understand that there is a level of uncertainty in the stock market that you can never reduce. You can never reduce. It's called irreducible uncertainty. It just means that we could try to hedge out every risk for you, but at one point, we just don't know if a meteor is going to hit. We just don't know if a war is going to erupt. We just don't know if a pandemic is going to show up. There's uncertainty you cannot get rid of, and you must accept that. And the minute you accept the fact that you don't know the future, you've already started to become one of the best investors of all time. You do. Once you can accept that fact, and you know that it doesn't matter, that we can still succeed. I don't know what the future's going to hold, but I don't know. I think I'm doing pretty well in my retirement accounts. Once you accept that fact, you've started to take a step in the right direction.
Yeah, I mean, I think we've been kicking around that idea here where everybody feels a certain degree of unease about any amount of uncertainty, which is why people are willing to pay premiums in order to insure things. But if you were trying to insure every possible eventuality that might befall you in life, you'd go bankrupt in an hour. So I think that to be a good investor is to acknowledge and accept that you have to take it on faith.
And remember, the stock market doesn't hate uncertainty. I very often hear that investors and advisors sometimes say that, and I like to correct them. We have no idea what's going to happen tomorrow. So there's certainly, the stock market doesn't hate uncertainty. If it hated uncertainty, the stock market would never go anywhere. What it hates is surprises. The stock market hates surprises, pandemics, tariff numbers that we've never expected, inflation, Federal Reserve. It hates surprises. Just like over the weekend, there was an attack in Iran, Israel, the U.S., B-2 bombers, the whole thing. Is the Middle East, is unease in the Middle East a surprise to the stock market? Of course it's not. It happens literally every few months. The stock market opened Monday up, oil was down. That's not, just remember, the stock market knows about Middle East tension, I promise you.
Well, and I think that's funny too, because early this year, we had a good number of people that were really wanting to talk about estate planning topics because this fear that, we're going to revert to the pre-2017 estate tax threshold, that old tax regime. And what I kind of told people is the market is expecting this to get resolved, because if it wasn't, it would be priced in and we would be lower, or people would actually be moving into ILETs and trying to get money out of their estate. The market is expecting that this will get,
The point you're making is this. I have a great chart for this if we were ever to do like a live presentation down there. Like
right.
if the world, if we knew what the future was going to hold, you would not need to plan, okay? If you knew exactly what was going to happen, you would need zero financial planning, because you'd be like, I know what's going to happen. We plan because the world's uncertain. We plan to take into account what might happen with the tax code, what might happen in the world. That's why we plan. In fact, I say this to clients who are nervous. We're building the lifeboat for you. Like, this team builds lifeboats. That's what they do. So when the waters get choppy and icy, why jump out of your lifeboat? Like, you're already in it. So I think it's really important to remember that planning is the key to all of this. And that's what we like to constantly reiterate.
Yeah, I think Daniel Kahneman, when he was interviewed about the great financial crisis, like 08, 09, he said a lot of people took the wrong lesson from that, because the lesson they took from that was, CLOs, CDOs, leverage products, those are dangerous, and we should stay away from those. We shouldn't own financial stocks either. But what he meant for people to take away from that was unpredictable things happen all the time. And that, I think Scott and I's opinion on that is that we're constructing a portfolio for most people that weirdly enough or bizarrely enough is trying to anticipate the unexpected, so that a shock like we received in early April doesn't totally derail a retirement or a middle career person saving for their retirement or whatever the case might be.
Nobody, like no bridge builder builds a bridge for a maximum load. Okay, they're like, oh, at most there'll be 20 semis. At most this thing will carry 500 tons. No, they build it for 3x that, because they're like, what happens if there's that many trucks and then they all stop?
Yeah.
And then it rains. Like, they build it for 3x their maximum. Just like you and Baird and all the advisors here build plans for the bad scenario.
The third standard deviation. Yeah, it's like Walmart. Walmart constructs its parking lot with Christmas in mind, not with a Tuesday in July.
No.
Yeah. I don't know. All these things are really fascinating to me, but like the lasering on the behavioral part is the way that everybody will understand what's important, because how you react is everything.
Yeah, and we had kind of an interesting discussion offline where you've read a ton of personal finance books, you've read a ton of behavioral finance books, and it seems to me like most of those books can be distilled down to a couple of sentences, which is to be a successful investor, you need to spend less than you make and invest that difference in the United States economy and then just let it compound for 30 or 40 years. Am I missing something?
Here's what you're missing. You're missing the fact that human beings don't live over 30-year periods. That's what I really think you're missing. In fact, I kind of get upset when an advisor shows a client a chart from like 80 years, and they're like, hey, look what happened over 80 years. And then the client's like, well, you know what? Like, I have to go home, and I have to cook dinner, and then I have to think about tomorrow. The mistake a lot of people make is trying to think over like century or decade-long periods, when most people think over short time frames. That's how in general human beings react. So it's great advice. It's the correct advice. But I think the better way of saying this is, in order for you to succeed over the long run, I'm going to get you through the day-to-day. And that's what I want to focus on here. Because when you get through day-to-day, you will obtain the long run. That's how I like to say it.
Yeah, and you're right. It is so much easier to think about, say even a 5-year time window, as opposed to we pull out this Monte Carlo allocation and 30 years with 1,000 different scenarios. You get lost very easily.
30 years, I can't even think about 1 minute. 30 years is crazy, right?
Yeah, I guess it's everybody. Well, maybe not everybody intuitively understands that having a long-term perspective is generally a precondition for success, especially in the stock market. But you have to balance that against everyday needs, right? You're totally right about that. And we work principally with retirees who are actively taking income from their portfolios. So we do need to deliver a stream of income that they can rely on, but there's a portion of their portfolio, which most people for whatever reason are most concerned with, which is the equity piece, that they cannot help themselves. They look at it, they agonize about it, even though they know a big chunk of that, for many of our clients, is going to go to their children. But yet they still get hung up on these big pullbacks, even if the bond portion of their portfolio is doing fine. And it's like, how do we square that with them, where it's like, we've got your day-to-day needs met, but yet you're still concerned about this money that is 15 years out?
Guys, I looked at the worst 20-year period to ever retire in the United States in history. You know what that 20-year period is? I'll just throw it out here. It's 1962 to 1982. That's the worst 20-year period to have ever retired.
Makes sense.
Bear markets, inflation, wars. It was awful.
Oil embargo, Watergate.
A retired couple in a 60-40 actually would have successfully navigated that 20-year period. Just a plain old vanilla 60-40 would have successfully navigated it, and they would not have run out of money. Now, that requires a lot of inputs, right? How much you're spending, like the whole thing. But what I'm trying to make the point is that you're not in the worst 20-year period to retire ever right now. You're just not. Like, the United States economy and stock market have done really well. But even if you were, sticking to a diversified plan over a 20-year period is the answer.
And coincidentally, the 60-40 was $60 in the S&P 500 back then.
It probably was, right? Like, I mean, it was so cheap back then.
Yeah.
Oh, God.
I think question then, if we're talking about, well, what we want to do is not get too focused on things that are happening day to day. If you are going to talk about something that's happened day to day, like, tariffs or something that's happening, say, in 2025, what actually piques your interest?
The thing that really impacts the market the most is what the Federal Reserve is doing. And the Federal Reserve is just this entity that sets monetary policy in the United States. They set interest rate policy. That really matters. Okay, of all the things we talk about, that's probably like number one. Number two would be this tax bill, because there's a lot of ramifications for that. But what is the Federal Reserve going to do with interest rates is a massive, massive part of our day-to-day lives. It impacts lending, it impacts home construction, it impacts the stock market, all these things. So if I was to look at something on a day-to-day basis, it would be, what does the market think they're going to do? Cut rates or hike rates? And right now it's leaning towards cut. There's been a lot of language about cutting. That's generally good for the stock market, generally. There's no guarantees here. That's what I would focus on if I was looking for just one thing to think about on a day-to-day basis. But other than that, I don't think about the White House. I don't think about Iran. I don't think about the national debt. I don't think about central bank digital currencies. All these things that we talk about that really have no impact on the day-to-day of the stock market.
I mean, the things people love to talk about and speculate about, that's for sure.
Yeah. I mean, you guys, I can't even tell you how many national debt questions I get. I get so many. I have an entire video series with my partner Ross on the national debt. So if you have questions about it, this team will get it to you. But it's wild to me that people care about the national debt. The funny thing is that the only people that seem to care about the national debt are the party not in power.
Yeah.
Yes.
It flips. If you're not in power, you care about the national debt. It's very weird that way.
Well, no, and it's funny how cyclical that is, because I feel like that was a conversation in the late 90s, early 2000s, and then it just went away forever. I mean, quantitative easing happened, interest rates super low, and then now that's a conversation again. Probably you're right, because the party that's not in power is concerned about it.
And
I can show you cartoons and worries about the national debt all the way back to the 1920s, by the way. Every decade. I could show you. Every single decade.
It's like nobody wants to work. It's just the meme.
Same thing.
That keeps
it's just a meme.
coming back.
Yeah.
Well, I mean, it was the same with inflation. I mean, people have been worried about inflation for forever. And then it finally did rear its ugly head, and we addressed it with interest rates. But it's the same story. It was inflation was going to come roaring back, and it just never did and never did and never did until it finally did. So I just don't know if the debt is going to be not a problem until it is. But even if we thought it would be a problem, I'm not exactly clear what it would mean to address it. And I don't think anybody has the appetite to take that medicine, particularly not if you're a politician. No way.
No, neither party is going to cut spending. Let's be clear.
Let's be honest.
There's no party that's going to, and there's nobody going to cut Medicare and Social Security, because that party would be voted out of power and replaced with a party who would just reinstate it.
Right away.
There's just a lot of worries that are only exist because of the news, to be quite honest.
Totally agree with you. So Go ahead, Greg.
Oh, I was just going to say something else that we talked about offline was, it seems like the methods of successful investing are many, but the principles are few. And the same thing is with dieting. It seems like you can get to a very successful body weight, various methods, but the principles are all, or the core principles are all the same. And so I think, Morgan Housel, he's written 2 books. He's got another book coming out in October. These books keep coming out. Diet books keep coming out. What is our problem? Because it's we've never had more information more readily available about what it takes to be successful dietarily, exercise-wise, investing-wise. And yet I think we are all more confused about what it is that we should actually be doing. And why is it that we need to keep getting reminded about what sensible investing actually looks like?
You know what people hate? They just outright hate? Simple answers. For some reason, people hate simple answers. Humans like to reject the notion that something can be so simple. It must be complex, right? In order to be a successful investor, it must be complex, right? No, actually it's not. In order to be successfully lose weight, you have to eat less calories than you take in, and you have to burn some. It's just that simple. A doctor could tell you that. But if you went into his office and he told you that, you'd walk out and be like, I didn't get my money's worth. I just paid him $500. I didn't get. Where's the pill? Where's the complex thing? Where's the 6 or 7 step thing I need to do? You'd feel like you got ripped off. Investing is pretty simple, which is invest more than it's invest more than you spend, and put it in the market and wait. That's really it. But nobody wants to hear it. Everybody wants to be told the get rich quick scheme. Everybody wants 0 DTE options or crypto, or they want GameStop, or they want meme coins, or nobody can accept the fact. Yeah. Nobody can accept the fact that the simple answer is almost always the right one.
It's curious, though, because J.L. Collins, who I'm sure you're familiar with his work, he wrote The Simple Path to Wealth, and then Andrew Tobias, he wrote The Only Investment Guide You'll Ever Need. Those seem to be pretty popular personal finance books, and yet it seems like the adherence piece just escapes us. It's okay, well, they're telling me the very simple things that I need to do, but is this all just a problem of adherence?
It's the news. It's the news. It's the consumption of media that is meant to scare you. That is primarily the mistake that retail investors make, is they watch so much news. They're in your offices saying, what about X? I really deeply believe that. I deeply, deeply believe the news is the number one impediment to an advisor's success rate. And the more you consume, the worse you'll be.
I think you're right, because we were talking about how it's so hard to lose weight and stuff like that. And we were talking about how, as a people, we are not used to abundance, and just being able to get whatever you want at the end of the shelf. Same thing with news. You can get far left, far right, in the middle, whatever kind of news out there at the tip of your fingers.
And you can get it 24 hours a day, and it's primarily negative. So I have a saying on my Twitter account. I'm a pretty decent Twitter follower, I think. I have my pinned tweet that says, "Pessimists sound smart, but optimists make money." And I truly believe that. Like, pessimism sounds really seductive. Like, somebody telling you what's going to go wrong is really seductive. Oh yeah, that could go wrong. That could go wrong. Yeah. But optimists are the ones that make money, because they believe that, yes, something can go wrong, but over the long run, things go mostly right, and you get to benefit from that. I'll tell you guys, I've never seen a wing of a hospital named after somebody that holds cash. Like, they just don't name wings of hospitals after those people. They name them after people who start businesses and take risks and understand that the world's a crazy place, and they get to benefit from risking, being an entrepreneur, and then they get the wings of hospitals named after them.
Not a lot of business schools named after cash holders either.
Yeah. I was at an event at Baird where you spoke on the last day, which was, I thought, a great move by them, because you brought a lot of energy on the last day. And you spoke about how people have this need to do something that they would regard as impressive. And the story you told was, no one's ever been at a backyard barbecue and been like, "Oh, what's your advisor doing for you?" He's like, "Oh, he's got me in a 60-40. And you're like, "The 60-40? Ooh, wow." Yeah, so I think people have these two contradictory desires. One of which is they do want to be sensible. They want to do things that are going to build wealth over time. They want to leave money to their kids. They want to fund their retirement accounts. But at the same time, they have this persistent itch for complexity. So how do we balance those two?
I have something that I like to call a cowboy portfolio, and I, like Texas, maybe this will work for Texas. Look, if you have a client who you have a diversified financial plan for with holdings or whatever, great. But what if you sliced off 5% of it and said, "Hey, I know you have that itch you want to scratch. I know that you have that thing that your friend said maybe you should. Maybe it's okay to have a tiny portion to scratch the itch, because that's behavioral finance at its core, which is we're humans. We have our own frailties, and we have our own ups and downs. I'm going to scratch the itch instead of telling you no, because if I tell you no, you might just go do it somewhere else without me."
Right.
I call it the cowboy portfolio, and you know what? I think that is probably a smart way to think about being human.
Yeah.
Yeah, it's kind of like a cheat day on the diet.
Or it's like the old dad advice: if you're going to do something stupid, you may as well be smart about it. Which at my house means just wait till mom not home. Yeah.
So I think it's fine. I think if you have a client who's just like, "Hey, I was thinking about this," there has to be some way to help the client understand that the plan is what we're looking for. But you know what? Hey, we can slice you off something to help you scratch that itch, and you can do it in a way that's not catastrophic.
Yeah. I think it's don't let optimal be don't let that prevent you from doing something practical.
Yeah, totally.
So, Michael, we were going to also ask you, maybe, and this is where we close for today, we started to do a segment on the podcast called Financial Mythbusters. And what we're trying to do is kind of touch on some fin talk or financial influencers, go through some of their ideas, maybe poke holes in it. How do you feel about maybe the fin talk phenomenon, what you hear on it? Do you think that the advice is good? Where do you think it's going to go?
First of all, I love this because I've also come to the conclusion that I will be a mythbuster the rest of my career. So you guys doing this is just right up my alley. I'm gonna be talking about politics and mythbusting the rest of my career. So the first thing I want everybody to remember with influencers like financial TikTok, Instagram, whatever, Twitter, is you have to ask yourself one thing: are they selling me anything? Is the person selling something? Because what you'll very often see is somebody go and say, "Hey, the dollar's collapsing. The dollar's declining rapidly. You need to just not be in stocks. You're in trouble. You need to buy gold." And then you do a little digging and that person sells gold, right? Yes. So question number one, am I being sold to? What are they selling? Okay. And then number two, is what they're saying sound really smart, but yet they don't know what they're talking about? Because charlatans are really, really good at persuading you that things are true when they're really not. And there's so many of them out there. So it's really, really important to remember that the fancier something sounds, the less likely it is to be true. And the more outlandish something is, the less likely it is to be true. But with the rise of AI, we're all in trouble because we're not going to know what's true and what's not pretty soon.
True.
Like the videos, it's like I've seen videos online where I can't believe they're not real. I literally cannot believe it. So this is when you really need to focus on like trusted sources.
Well, that was like every 6 months or so, I have somebody that emails me about some guaranteed 14% interest product that somebody on Facebook or online showed them. And every time I look into it, it's either just an outright scam, which are everywhere. We're seeing them all the time, or it is backed by the third lien on some Antiguan CDs or something like it's just...
You got to ask yourself, what am I being sold? Like, you really, really do. I've seen people like, they said, hey, they went to their advisor and me, they said, there's this AI system that does day trading. The AI predicts like what the stock prices are going to do, and it says that for $99 a month, I get all the signals. I'm like, hey, you're being sold to. If that worked, would they sell it for $99 a month? There's no way.
No. I think if anybody can find mispriced assets in the market, they're not going to sell them to you for $99 a month. Not a chance. They would just they want to be the only people in that profit pool, and they want to absorb all of that until it's finally been arbitraged away. They're not going to sell it away. No way.
No, not at all. So just be careful of that. I want you guys watching and listening to know that at Baird, we're not trying to sell you crazy products. We're just here to financial plan and to myth bust and to help you get through the day-to-day. I think that's what our main goal is.
And one last thought on that. They might not be selling you gold or stocks or mutual funds or ETFs, but if they're not, they're just selling themselves, and they've probably monetized the outlandishness of their takes, the hot takes that they're providing you, so that they get paid by the advertisers on Instagram or Twitter or whatever it is.
That's right. Yeah, they're looking for clicks. They're not helping you.
Well, I find it interesting on that note, Scott, where we'll occasionally have a client who brings something like this to our attention. It's an extraordinary claim for which they have not required extraordinary evidence, and then we will make a recommendation for like a middle-of-the-road bond fund. And they'll be like, well, why would we own that? Why would we own that? Sell me on that. And you're like, what? It's like you're about to buy this third tax lien 14% high-yield product from this guy you've never met on Facebook, but this short-term bond fund, you're going to look at a very close eye. Yeah.
People want complexity.
They do.
As human beings.
Well, Mike, this was fun. I hope we have you back sometime soon. Where can people find you?
Yeah, so I am on Twitter. You can Google Twitter. If you Google Mike Antonelli, Bull and Baird, you'll see most of my stuff. The video series that my friend Ross and I do is called All That Matters. It comes on Baird's YouTube channel. I have an email list. If you want to get on my email list for that, just tell these advisors. We'll get you on it. And then I do branch travel every now and then. Maybe I can come down to the Houston area and do some speeches. So I go on the road every now and then, too.
We'd love to have you.
Awesome, Mike. Thanks so much.
Thank you for listening to another episode of the Personal Finance Project. This show would not exist without the help of our brilliant creative director, Kira Minifield. Kira, thank you for everything you do to keep this show running. On to the disclosures. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. Annuities carry unique risks, including market risk, investment risk, and claims-paying abilities of the insurer. There may also be instances where a contract will pay out less than the premiums paid or expire within the lifetime of the insured. There may be penalties for early withdrawal, and they are not insured by the FDIC because they are insurance, not an investment. Investors should consider carefully information contained in the prospectus or, if available, the summary prospectus, including investment objectives, risks, charges, and expenses. You can request a prospectus by reaching out to your financial advisor. Please read the prospectus carefully before investing. Investment returns will fluctuate and are subject to market volatility, so that an investor's shares, when redeemed or sold, may be worth more or less than their original cost. Unlike mutual funds, shares of ETFs are not individually redeemable directly with the ETF. Shares of ETFs are bought and sold at market price, which may be higher or lower than the net asset value, NAV. Baird does not issue or underwrite mortgages and does not service mortgage lending services. Any references to mortgages in the financial services offerings are purely intended to convey an engagement in this holistic planning process, with this as one piece of the larger picture, which may or may not apply to all clients. This broadcast may not be reproduced without express permission of Robert W. Baird & Co., Incorporated.